What's going on? Oh, wait. Do the boring thing first, and then we'll get going.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker, a registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockwell.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss that you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or spread your information to anyone.
Okay, let's see what is going on today. Lots of fun. Oh, we had the best example earlier. Let me show you this. All right. We had the best example earlier of when I say shorting laggards. So we were at, go back to the post, not that post. So at the end of the previous day in the morning, like this morning, we, until I make a new post, we comment at the end of yesterday's post. So we keep commenting on the new post generally until about 8 in the morning, and then by then I usually have a new post up. So this morning, first thing, we talked about, okay, so at, what time was this? This was 6:30. Okay, so at 6:30, I said, see, I'm looking now. I look at Europe and I look at what's going on. I said, look, Europe is bouncing back already. So take the TF 113.85 and the ES 23.90 money and run. So in other words, from our previous post, and that was at 6:30, and you can't see it on these charts, so that's not too helpful. But then I said the Nasdaq can be the fresh horse below 53.65 if the others fail, and I said, and that's my market. So in other words, if those guys start failing, then the Nasdaq becomes what we call a fresh horse. Now, so what I said is, there's a great example of what I mean by that. So I'll show you. All right, so you understand the concept, though, is that we had 13.85 and 23.90, and I said at 56.75 the Nasdaq was the fresh horse. So what had happened? So I'll make this one day if I can. There we go. Okay, that's going to let us see it. Whoop. Yeah. Again, we'll be the same time frame pretty much. There we go. Okay. So this was 6:30. So what had happened is that I thought these guys were bottoming out. And everybody was down at the bottom except the NASDAQ was much higher. And now you need a little more context. I'm sorry. All right, here we go. Now I'm going to put a 2-day context on the thing to show you what I meant. So I should always be looking at all the different time frames. So, generally the index has moved pretty much in track, but the NASDAQ has been off in its own world for a long time. So what happened is everybody bottomed out. Okay, everyone had bottomed out. Here we are at the 6:30 mark down here, this part of the day. And everyone had bottomed out, except look at the NASDAQ at 6:30. The NASDAQ was way the frick up here in La La Land. And there's 56.75, this purple line. So I said, wow, that's a good shorting line. All right. So while we took the money and off the table on these, we were satisfied that this was as low as we were going to go. The Nasdaq hadn't even come down. So I said, if we're going to short something, let's short the fresh horse, the one that hasn't gone anywhere yet. That's what a fresh horse means. It's like, from the Pony Express days when the guy would ride, I don't know how far horses go, but the guy would ride 100 miles on a horse, and then he would get a fresh horse. He'd keep riding. Okay, he'd ride. He would keep the guy with the leathers would keep riding, or give the leathers to another guy who keeps riding. But the point is, you get a fresh horse, and the male keeps going at top speed. You don't just beat this one horse to death on a 2,000-mile run across country. They kept switching horses, and that's what you have to do. Even if you're on track, if you take a look and say, "Wow, this index hasn't moved yet," if it's going to catch up, it could give you a much better move to the upside or to the downside than the ones you're on. So in this particular case, everyone had fallen, and everyone had tested the green line except the Nasdaq, who was still up at the purple line. So that made the Nasdaq a good short at the purple line, and what did it do? It came right down and tested the green line. And now it's lagging on the bounce, so it actually became a fresh horse to the upside too. So that is exactly what we mean by fresh horses. In other words, everybody's made a move except one of the indexes. Now, so you set yourself a barrier. So we set a barrier to say, well, if these other indexes stay down, then we want to bet that the Nasdaq starts falling. And that allowed us to make a play on the Nasdaq. And it's the same thing. So whenever you see the indexes all going in weight, you got to start right away looking and say, who hasn't moved yet? Who can I still play? Like right now, people took off, right? We were looking at this purple line. Everyone took off again except the Nikkei. And the dollar is coming up. So if the dollar is going up, then the Nikkei is going to be happy about it. So right now, the Nikkei at 19,965, I would put 19,950 as a stop, but the Nikkei is a good long right now. But I don't think, again, 1,400 is where I like to short the Russell, so I'm not too enthusiastic about playing here. Not only 1,400, but 2,400 on the S&P. I think these are all silly numbers. So it's not a great play right now. But if they keep going up, then I'd go for the Nikkei. But I'm not saying go for the Nikkei because on the whole, I think it's kind of silly. Look what we got here. We got 155 on gasoline. That's huge, and that's done. We're done with that long. Okay. Oil, we're not done with. The 47.50 is great progress. Okay, really good recovery here. Natural gas pumped right up. We had a 320 long here, and that went well. And silver is still in bad shape. So we're waiting for that, but I like silver long here still. I like gold down here at 12.17. Could go lower, but if it goes lower, it's just more desirable. It's still the fair price for it. It's still down there. And there's coffee stopped trading today at 130. Now here's coffee again. That 135 line, man. You just play that 135 line over and over and over again, and just give you money. Those are good contracts to trade. So that's my futures topic for the morning. What else? Let's see what people are talking to. Oh, no comments. Wow. All right. Maybe everybody left. What else have we been doing for the last year? Oh, yesterday we went over the watch list. That's very important. Let's see where that is. Oh, I said we'll be looking over the watch list, and we actually did look over the watch list. Isn't that cool? We say watch a lot, don't we? Okay. So this is very important because, look, the market does not go down. It doesn't stay down, that's for sure. And so if the market's never going to go down again, you need to have longs in your portfolio. So who's still good off our watch list? We had 21 stocks to start with. 11 of them already took off. So we're looking at some of the 10. Some of the 10 that we like the best that haven't gone anywhere yet, right? So we already have 11 winners. We need to, and some of these are winners, but not so much that we can't do them anymore. So BMY, we like them, and there's no change in the trade. The original pick was on 3.5, which is here, and they're basically in the same spot. So it's a long-term spread, selling the $50 puts, which is still way down there, and buying the 50-60 spread, and that's a great trade. So we still like them. ESRX, got cheaper than here. 217 was around here, and there now went from 70 to 60. So now we like them enough to add into the long-term portfolio. No, I'm sorry, we did add them to the long-term portfolio. Silly me. We added them to the long-term portfolio on 217. We sold the 2019-65 puts, but we sold them to 750. So that's a 57.50 net. That's over here. Our net is over here. So this little dip doesn't really bother us, and in fact, it might be attractive to sell some more, but there's no hurry. We're not in an emergency here. But I like Express Scripts. And I think, didn't we talk about adding a bulk call spread then? Anyway, at this point, you can do better than our original trade. Let's take a look. ESRX 2019-65 puts. Where's my thing? Huh. What is wrong with this thing? ESR. Slow. All right. 2019-65 puts are now 885 or 860, whatever. Okay, so 860. And we sold them for 750. So we're down a buck. It's not really terrible, is it, considering? So we sold them here, and they're only down a buck. That's kind of weird, actually. But I still like it. But you know what? I don't like it as much because that's kind of a ripoff. I would have expected to get 10 at least. I don't understand why it's so low. That's not nice. 2019. This is the 2019s. These are the 65s, and that's a rip-off price, man. But anyway, point being, you can still do it now. If you want to go even lower, though, 60.99. So if we wanted to go to like the 60s, or let's say the 57.50, you can sell those for 520, not 505. That's too low. You can sell them for like 520, and then you can put that 520 to good use by taking the 60s for 940 and selling maybe the 72.50s for 340. Well, not 340, but just for argument's sake. So you'd have here a $5 cost on a 12.50 spread, less the $5 here. So you basically have a free $12 spread on the SRX. So your worst case scenario, you sell these puts and you buy the 60 72.50 spread. Is that the one we said? Yes. Then you buy the 70 62.50 spread. I'm sorry, the 60 72.50 spread. But so you get the 60 72.50 spread for about $5. You sell the 57.50 puts for $5. So now you spend no cash out of pocket, and essentially your only downside to the trade is owning ESRX for 57.50. That's your worst case. The only bad thing that can happen to you is you get assigned to 57.50. Now, if that happens, well, first of all, while you're waiting, this is the important thing to know. Here we go. So if I do sell these, $5, whatever. So if I sell them, Jesus. I mean, anyway, 10 seconds between when you press it and when it goes. What was I going to say? Oh, yeah, so if you sell 10 of them, you collect $5,000. Your margin buying power is, your buying power effect is $5,000. So it takes $5,000 in margin to collect $5,000. That's not bad. That's tough. Oh, well, gee. What the hell? Oh, Thinkorswim just crashed. So much for that. Oh, that's nasty. Are you guys still on? Is everything okay? That's weird. Okay. I knew it was too slow. There's something wrong with it. Let's see. All right, hang on. I got to restart it. So hang on. I'm going to have to pause the sharing. That work? How would I know if it worked? Okay. Hang on, man. Let's see if I can get it started up again. Ugh, all those days. Oh, you can still hear me. Yeah, that's true. Of course, yeah. I have to put the screen sharing. I have to put the audio. Anywho, so other than that, Comey asked to appear at the Senate panel Tuesday. Oh, that's interesting. This is going to be fun. And it looks like Spice is coming out and things and stuff. I guess he always does it, doesn't he? Every day say something. Today will be fun, though. How would you like to be that guy? I just have to get up there and know that anything you say should be imitated by Melissa McCarthy dressing in drag to be you on Saturday. That is not pleasant. Those press secretaries tend to drop like flies. All right, so now Comey's going to testify he has nothing to lose. Actually, you probably got a lot to lose. I'm sure they don't take it well if you betray. All right. What are you telling me? Hang on. Okay. Be back on sharing in a second, so hang on. So get the thing set up properly. Sure, it works. That's a little better now. It's moving. Although we're not screen sharing. I think they don't like each other, the screen sharing app and Thinkorswim. Okay, that. Let's start sharing again. And now I have no idea if you can see it. Can you see it now? Yes, no, maybe? I hope so. Oh, good, okay. Anyway, so where were we? I forgot what happened. Oh, yeah, so we were talking about how I would rather short than go long. So here's, $13.99. We basically hit the 1,400 mark where we wanted to go short here. We're back up to 56.75. God, these numbers are hard. 56.75, good shorting line here. The Dow's dropping nicely. Oil's still up. That's good for the other trades. The dollar's moving up. That puts pressure on everybody to go down. So all is well right now. Everything's good. This is my favorite short at the moment. Here, I tell you what. Let's do it. We'll log it in just to have it. Active trader. Contract still down a bit. Is my oil contract still down a bit? None of my trades are working out from last week, but I still have them. The Russell, right? We talked about the Russell. So ideally, I'd like to short them. So let's just do one here and see what happens. How about there? How about there? Wait. I'm patient. As long as it's moving up, why would I execute the short? Let's let it find its spot. So there's 12 here and 3 there. There's more pressure up than down. 12 and 8, losing the pressure. Up, and there it goes. Well, that was fast. Okay. Now it's 12 and 9, 13, 7. Up, 12 and 2. Probably lucky to get this one. There we go. Okay. All right, so we'll just see how that goes. This is the market. So we're 1398.7, and we'll see if it stays below 1400. But I think probably tight stop over 1400 because if it blows through this, God knows what's going to happen. All right, so we'll just keep an eye on it, but that's the official trade at the moment. All right. I was talking about ESRX, was I? Oh, this thing. Yeah, you're right. Oh, I know. We were going to look up. Now I know what happened. We were going to look up ESRX. Thank you. We were going to look up the 2019. We did look up the 65 puts, and they only dropped $1, which I think is silly. And then we were talking about that spread. Boom. On to the next one. FCX. I talked about this morning in the article that China's screwing up all the commodities because the banks, the banking regulators, are saying to the banks, like, it's like, say, you guys wrote like $9.3 trillion worth of loans, and there aren't $9.3 trillion worth of assets in China. So, what gives? And that's essentially where we are right now. So what they're basically saying is they're saying they want to see. I had a nice. I picked out the segment. I had Google translate it for me, in fact, today. Boy, do I work hard. Gosh, I mean, who does this kind of stuff? So I found the actual Chinese banking regulation. Look, in Chapter 3, I'll open this up and show you what the original was. This is what I have to do this is what I do in my morning. People feel like, what are you doing at 4 in the morning? I'm like, this is what I do at 4 in the morning. I read Chinese papers, and then I get them translated. So that's the Chinese Banking Regulatory Commission. And the original page looked like that. But fortunately, Google says, would you like to translate this page? And it's amazing. I mean, this is like as good as Star Trek, because you just press translate, and it translates the page. And a good job, too. I got to say, considering it's all banking terms and crap, it does a really good job. But sorry, Jean-Luc, but that's pretty much all I need. Anyway, so it turns out that when you actually read this thing, it says Chapter 3, Risk Management, Article 15, the collateral received by a commercial bank shall meet the following basic conditions. The collateral, I like this A23D. The collateral is real, kind of like a Chinese menu, right? Like it's got little funny mistakes in it. So the collateral is real. That's a big problem for a lot of these banks. They're like, what do you mean the collateral is real? It's like, well, you actually have to have the collateral. The fact that they say they have collateral isn't good enough. China's like, to some extent, China's like America in the 30s, which is very dangerous because we had a depression in the 30s. Or more to the point, China's just around the late 20s, because in the 20s, the banks were lending to anything. Like America was booming, the economy was great, everything was fantastic, we were expanding out west, so people would lend money. Oh, you're building a railroad? Sure, here's a ton of money. Oh, you're going to make a ferry on the river? Here's money for that. Oh, you're going to build a factory? Whatever. Oh, all factories are successful. Here's money for a factory. That was the logic they were using back then. No matter what happened, you were in such an incredible phase of economic expansion that banks just wanted to put their little monies down on it and take part of whatever was happening. China's like that now. But unfortunately, the same problems occur, which is that banks don't understand what they're lending money on. And when they take the collateral, they're very subject to being conned by guys who say, like a guy, a Chinese industrialist will say, hey, I'm pledging all my steel and copper in these warehouses as collateral. So here's the problem. The regulators say, well, first of all, is this collateral real? Because what they do is, you know how it works, even with American banks. I mean, American banks have this problem all the time, too. You say, I'd like to inspect the collateral that you're pledging. Okay, well, it's not expected you're going to bring the iron steel, like tons and tons of iron steel into the bank. So the bank goes there. So what do? They call you up and make an appointment to visit your warehouse in a certain place on a certain day. Now, that's a problem because if you're a disreputable Chinese manufacturer, what you do is you move all of your iron and steel to the plant that he's visiting, and the other 10 warehouses are empty. But you claim that he's visiting one of 10 warehouses that are full of iron and steel. So that the collateral isn't real, even though you're acting like it's real. So it's not necessarily the bank that's ignoring the regulation, but the bank doesn't have the experience of being screwed often enough that they understand that there's a big risk here. Then there's the other thing. The relationship between the collateral is clear. The mortgage has the right to dispose of the collateral. They don't have the kind of central systems that we do, where you're basically putting liens on properties and filing it in the county courthouse and so on and so forth. They don't have all those mechanisms that make you sure. What do you call it? There's a UCC. When somebody gives you a lease, they file in the state courthouses. They file a Uniform Commercial Code a lien, and that shows that they have a lien on your asset. And that means the next guy who goes to give you a lease already sees that somebody else, you've already pledged your assets to somebody else. That is not a clear thing in China. They don't have those mechanisms. So it's again, very dangerous for the lenders because they don't know for sure that the collateral is clearly yours. The collateral refers to laws and regulations, blah, 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 and the collateral has a good ability to achieve liquidity. That's another issue, of course, obviously, because you think you've got, if you're doing copper, for example, okay, so, and this is an audit issue for China, too, because, let's take copper. So, a bank, copper's actually been doing good. Oh, okay, here. Oh, here's a good example. Okay. So, in 2011, the bank wrote you a 10-year loan for $45 billion. Okay? Well, that's a lot, but all right, so say $450 million, let's be a realistic number. So the bank lends you $450 million, and you pledge 1 million pounds of copper, you pledge 100 million pounds of copper as collateral, okay? So $450 million, or $450 a pound. So you've got this loan outstanding, you're paying the interest on the loan, and meanwhile you're in trouble because your business is, your copper is your business, you're making less and less money, you're servicing your bank loan, but meanwhile the bank still has, as if they have an asset that's worth $450 billion, $450 million asset on the table. But the fact is, you've only got 250. Even if you have the same 100 million, 100 million pounds of copper, it's not as much because it fell from 450 to 250. So now you've only got $250 million worth. So there's a hole in the bank's balance sheet of $200 million on that loan. So that's the kind of stuff they're talking about. And they're basically, this is like the 1, 2, 3s of American banking, but the Chinese don't know that. Okay? Look, the economy is growing so fast that the guys who were bankers, same as America in the 20s, okay? The guys who were bankers were farmers 10 years ago. Okay, obviously you're getting the cream of the crop guys who are bankers, but the guys who went to business school or whatever, but they don't have 20 years and 30 years experience banking. Some do, some don't. But there's so many new banks and so many new people working in the new banks and so on and so forth. They just don't know all the stuff. And it makes them a lot easier to con. And also the problem is that the states run most of the banks. So when the states run the banks, they tend to just sort of follow some basic, they follow a lot of regimes that may or may not be the right way to go as far as doing loans and all. So they recognize, the good thing is China's recognizing this and they're trying to fix it. But unfortunately, there's $9.3 trillion worth of corporate bonds outstanding, and they're worried that defaults can creep. They're already moving towards like a 10% default rate. They're worried about it creeping like to a 20% default rate. Nobody can afford to lose $1 trillion. We did on Wall Street, and look what happened in this country, right? Look what happened in this country. The market doubled. But, in reality, though, that's what happens when you lose $1.3 trillion. Your entire market collapses and everything falls apart, and the Federal Reserve has to come in and save everybody and so on and so forth, and it takes 10 years to dig your way out of it. China would like to avoid that. So they're starting by doing some painful steps and cracking down on the bank lending. The problem is, of course, any kind of cracking down and stuff like that can cause some amount of economic dislocation. And that's what we're worried about this summer. Our number one worry this summer is China having a correction just like they did in 2015. And let's take a look at FXI, just to give you a good example. So what happened in 2015? FXI was going up and up and up, and all of a sudden, boom, and it started plunging like crazy. Went from 50, ultimately almost 50% down to 27. And they spent all this time recovering just to get back to where they were at the end of 2014. So at this entire, if you're a Chinese investor, this has been a wasted 3 years. That's your market, and gone absolutely nowhere. You had a little chance to get out ahead, but if you were greedy and you didn't take the 20-25% gain up here, then that's it. You've been waiting the whole time since just to get back to where you were. Okay, that's China's market right now. So the underpriced, overpriced, hard to say, but the banking issues make me think that we're going to have another little correction. We haven't had a panic in this long, right? I mean, it's this minor little pullback, but generally there's been no major panic this whole time in the last 2 years. Now they're messing around with regulations just like they did here, and it's likely to cause at least somewhat of a pullback. So if you call this a channel from here to here to here, I think they'll at least be testing probably this far. So this is 38, so 150. So 150 below would be about 35.50. I would say at least a 35.50 here, which is a 10% correction. That's what we're looking for in China over the summer. And if China goes down 10%, it's going to be very hard for us to avoid. What did we do when China went down from May of 2015? So now let's look over to the SPX. And here we are. So China fell. It took us a while to even bother caring. But then suddenly we went from 2130 to 1867, which is not a terrible fall. But it's, what is that, 300 points? Correct? Yeah, 300 points, let's say, a little less than 300 points. We'll call it 10%. So, they fall 30%, we fall 10%. This is not horrifying, but it was a good correction. And that's what we'd like. We'd love to see that because that'll take us back to the 200-day moving average, and we'll be happy. I'll be thrilled to buy stuff at the 200-day moving average. That's a good price. Where we are now is crazy. I'll be very happy. If we come back down here, great. If we come back down here, I will be on a buying frenzy. Because I think the central bank can easily, the Fed can easily step in and do something. I think they still got plenty of ammunition to save us, so I don't see them letting us go below the 2100 line. All right, how are we doing? Welcome to ESR. NYSE 3-to-1 ratio on volume. Is the street thinking that Trump is a clear path for his policy? 3-to-1 ratio? You mean today or in general? It can't be in general. No, I think the street today thinks Trump is untouchable. I think you got to, okay. So yeah, they think he has a clear path for his policies because he fired the freaking guy who's investigating him, and there's no repercussion. Other than a little bit of grumbling from the liberals, who cares about what they think anyway. There's no real repercussion in what he does. Nobody's even said the word impeach. I find that amazing. I mean, it's a serious attack on our democracy. But you're not going to get anywhere with this. It's just he can do whatever he wants, and since whatever he wants is to cut taxes considerably, then that's foolish. Hillary says, speaking of Trump, Hillary says VIX. She likes the VIX. The problem with the VIX on the VX futures is there's no such thing as a VIX. In other words, you're not buying a thing. There's no delivery of the VIX. So let's take a look at VX. This is my objection to it. When you play the VIX futures, you're making a bet. It's like if you bet on a horse race. Because the VIX futures, and these expire in May, they're monthly contracts. The VIX futures, you're buying a future contract that expires on May and is absolutely worthless if it doesn't hit your number. Now, you can say the same thing about anything, silver, gold, whatever. You can say the same thing. Oh, look, we're up $75. That's nice. I forgot. I usually buy 2 Russell contracts. I hate the fact it's only $5 a point now. It used to be $10 a point. I'm sorry, not 10. It's $50 per point, $5 per 10. Used to be $100 per point, which was how I like to play it. Well, it's my bad. I forgot to buy it. But anyway, at least it's working. So where were we? Oh yeah. So the VIX. So you're basically just betting on the outcome of the VIX into May, and then you're betting on now. And on top of that, since there's no actual thing that's a VIX, you're betting on what people are betting on. It's a pari-mutuel betting, like a horse track. Like when you're on a horse track, you're not really betting on a horse. It's not like it's not like Vegas where they set odds on a fight or on a football game and it pretty much stays where it is. In Vegas, in horse racing, you're betting against the other people at the track. So if a lot of people put the money on a certain horse, it becomes the favorite based on the fact a lot of people put money on it, and the odds change. And so if you bet a long shot and you put a lot of money on a long shot, the odds for the long shot go down because you put a lot of money on it. And you're only betting against the other people at the track, and the house takes like 20% off the top. So no matter what, they don't give a shit who wins because all you're doing is betting against each other, and they're going to take a slice of what you bet. That's exactly what's going on here. Okay, so there's no thing, you can't get delivery of VIX. There's no such thing as a VIX. It's just a number, you're betting on where it turns up. And again, you're betting against other people who are betting. And as you can see, there's a lot of people betting. Look at it. See, we trade this contract, 4 contracts bid here, 15 bid here. You bet on the VIX, 1,200 people are betting 1150. 499 people are willing to buy a little bit below 1150. That's a pretty active contract. All right, so do I like long? I like long. I would probably go with a month out. I assume there's a month out. I assume you can do a VX. This says May. VX N7, I'm just going to guess. I don't think that's the thing. VX. I don't know, VX N7. Wait. Oh, yeah, it's a thing. Okay. So, in theory, I imagine that's July, VXN7. I would play the July ones, just because that way at least you don't have to keep rolling your contracts. So, the current ones, wow, it's a big difference, though. Wait a minute. Holy cow. So, you see you see where the betting is, though? VXN7 is at 1350. We're at 1150. VXN7. Wow, 1350. Does that mean M7 is 1250? Let's take a look. M7. 1250. What do you know? So the betting on the VIX is that it's going to go up $1 per month, or you're just being ripped off by $1 per month. That's the other thing you have to consider. Maybe they just arbitrarily raise the prices. Like I said, they're scalping your money. So maybe they're just arbitrarily raising the prices $1 a month. So anyway, so you could play it, but it's a weird sort of thing. So now let's take a look at VX and see if they have options. They have no options. So the problem is if you have here's the thing. If you have a July VIX contract and the VIX spikes up today, that doesn't mean your July contract will spike up because it's a completely independent bet. It's a bet on where the VIX will be on the July expiration versus your bet on where the VIX will be or versus where the VIX is today. All right? So, if I'm driving from my house to New York City is east of me, pretty much directly east. But along the way, I may head south and I may head north as the road turns, and I may not always be going east, right? But that wouldn't change your bet. So the bet that where I'm going in the next 5 minutes north, south, or east, right? Probably not west. But where I'm going the next 5 minutes, north, south, or east, does not correlate to where I will be at the time of my destination, in an hour when I get to New York. All right, you understand that? So in other words, when you bet a July contract, the fact that the contract changes in May doesn't, because there's no underlying, they're not necessarily connected. So I would just be very, very careful playing with this thing. It's not, if I were going to play it, which again I wouldn't because it's just too much hassle to bother with, but if I were going to play it, I would play it on a time when it spikes really low, which it already did. I mean, frankly, yesterday, let's get back to the regular VX, yesterday was ridiculous. It went down to 1110 here. And so that's silly. And probably 1150 is silly too, and probably it's going to go higher. I mean, I do think the VIX is going higher. I'm just telling you, it's a very, very unreliable thing to bet on. So just be careful, that's all. If you want to play with it, I think it's as fun as the next thing, but it's not something I would sit there and start, putting my concentration on. I have too much fun playing with oil and other stuff, so it's not my cup of tea. All right, so. Okay, so how would you play the VIX for the 6 month view? As I said, there's the problem, right? Because the 6 months has nothing to do with what happens today. So you could have a 6 month long, and VIX can go spiking up to double, and your thing may barely move at all because people think people think whatever's happening now will calm down within 6 months. So what would really be the point? The only way you're going to win is if sentiment becomes such that the 6 month contracts, people start moving their target on those and saying, wow, we're going to be so volatile in November. And really it's like, what would cause somebody to make that statement? It's like, whoa, what's going to be volatile in November? I would say next year with the elections, yeah, maybe that. But this year, I don't see any particular reason. So until we get closer, it's probably not going to do anything, and then your contract's going to erode on you, and too much. Not for me. That's the bottom line on that. Not for me. What's the platform I'm using? This is Thinkorswim. Yeah. From TD Ameritrade. Oh, thanks, Pat. He knows. I see option chains. What's that movie with the kid in the store? Oh, I see dead people. That's what it says. They're everywhere. I see nothing exciting going on at all. So back to what's more exciting than big trades. Let's take a look at some more trades. So Freeport. Oh yeah, that's how we got sidetracked. I love that. I will get back to something. Oh yeah, that's where that whole conversation came from. So Freeport, the copper's depressed because of the China nonsense and all the stuff that gets shuffled around, and people, the companies are being forced to liquidate so that they can show value and collateralize their loans. There are going to be probably a couple of major defaults in China because, if you're one by one auditing all your customers, you're going to find a few that have got problems. So we'll see what happens. Now, of course, these are state-owned banks, so it's up to the state, and the state can easily say, oh, no, we're sweeping that one under the rug. So they can do it, bank can do a whole audit, but when the regulator owns the bank, it doesn't always mean that you're going to get the result you think you're going to get. But anyway, so Freeport. Copper's great. If we have any kind of infrastructure, this thing's going to fly. I think it's a gift that you're able to buy it down here again, so I love that trade. GE, again, another one that benefits from infrastructure spending, and generally a good company, good solid long-term hold. They came down to a good price, time to buy. That's why we have a watch list, okay? It's like we watch companies, and when they get cheaper, we want to buy them. By the way, and that's the point. When I set these trades up, these weren't buys. They weren't highlighted or anything like that. But at the time, I said, here's the trade we should be looking at. And so we see that, and now today we say, oh, could we do better? It's like, yeah, we can do way better now. We could sell the $30 calls instead, and we could buy like the $25 calls or $27.50 calls and set up a spread. So that's the point of a watch list, though, is to have all these ideas that we could execute going forward. Gilead, we got all those. Gilead, we went for because on 217 we liked it, which was up here, and it kept teasing us around the space. So we've got plenty of Gilead at this point. Still like them, obviously, though. OLB, I just put that up the other day. They took off again, so they just had a good report, and they shot up today. I think one of the best value retailers because again I have two daughters, so I'm very aware. Two daughters, and so between them and the wife, and it's like I'm very aware of what's going on in Victoria's Secret, and more important, Pink. Oh, and actually no, it's Victoria's Secret, it's Pink, and the Bath and Body Works is another one because all these kids they give their parents candles. Apparently, candles is the thing they give people. Candles and perfume, and terrible perfume, are their favorite gifts, and they give it to each other, and they give it to their mothers, and it's just crazy. So it's like I'm constantly in candle stores, and the margins there are unbelievable. Apparently candles are incredibly cheap to make, and ridiculously expensive to sell. Or relatively expensive. It actually is a cheap gift, like you buy a candle for $10, but it costs them like 50 cents to make the candle. And practically the same is true of Victoria's Secret clothing, right? It's a piece of lace that costs $1, and they sell it for $20. That's how these things work. So, as a father of daughters, and knowing that half the population is women, I can tell you, and my school is very very racially diverse. We have everybody. We have and so my girls' friends are like the Muslim girls go there, the black girls go there, the white girls go there, the Spanish girls go there. Everybody goes there. It's not like they have friends who go, oh, I don't go to that. Everybody goes to Pink. It's crazy. So, and it's not a catalog-y thing. It's not the kind of thing where Amazon can put it out on a catalog. You gotta touch this stuff and feel it. Everybody wants to see it and smell it and taste and touch it. So I think it's a great store for that reason. Macy's. I like Macy's for the real estate aspect of the place. So they've been flat since we picked them. It's a long-term thing. It's a long-term turnaround, but I think they're a good, solid company. Yes, a portion of their sales goes online, but again, they're an upper middle class kind of place, and it's not. They don't get impacted as badly as some of the other stores. Those kind of shoppers tend to want the service. Just getting something in a box isn't as satisfying. People who shop at Macy's or Nordstrom's or Bloomingdale's, okay, they go into the store and a person comes up to them and says, "Can I help you?" And not like a teenager, but an actual person who actually knows what they're doing will come up to you and say, "Can I help you?" And they will make sure that you've got everything you need. And when you want to try on a shoe, they go back, and in 2 seconds they're back with the shoe. You don't sit there like you do in Foot Locker and wait 2 hours for the guy to find something in the back. It's like, and you don't say, "Oh, I've got 5 people ahead of you, and then you can try your shoe on." At Macy's, it's like you walk in, somebody runs up to you, they got your shoe, they got your size, they carry your stuff to the counter, they gift wrap it for you. It's a whole different experience, and Amazon doesn't really compete with that as well. Yes, they are denting their sales, but Amazon takes the 10% that's easy to take. But after that, after you get the low-hanging fruit, and Amazon knows this already because they're starting to open up retail stores. They took in any given store, there's 10% of the stuff, maybe 20%. That's easy to flip to Amazon. But then you got the rest of it. Then you get to the point where it's like, okay, now we're down to the stuff that's in the store. So Macy's has to rejigger their inventory and take into account the reality of Amazon and say, well, we're not going to sell that crap anymore. We're not going to sell batteries. We're not going to sell pots and pans. We're not going to sell kitchen supplies because that's easy to order online. We're not going to sell these electronics. They have to decide to sell. They look at their numbers and they look at their spreadsheets and they say, what is selling in our store? And they say, well, let's do more of that. But it's like a big battleship. It takes a long time for them to change course. But they do. They change course. They're seasonal buyers. In other words, so there's a season. They go to a trade show, and they make decisions at the trade show that will affect who they're buying for next year. So when they find out Amazon's denting a part of their business, it takes them a year to react. And again, it goes back to investors are not patient, and they don't want to ride out any kind of downturn in the business. And that's silly. I mean, Macy's been in business 150 years or something like that. It's like 100 years anyway. So they're not going anywhere. I know Sears is going out of business, but Sears has been run like crap forever. Macy's is not. Also, the store in Herald Square, Macy's Herald Square, they own that building. It's an entire city block in the center of Manhattan. It's worth billions. Company is so crazy undervalued. They have a $9 billion market cap. There's no value at all placed on their real estate. As I wrote up here, in fact, they have 900 stores and a $9 billion market cap. So they're being valued at $10 million per store, yet they have one store that's worth a couple of billion at least. And that's an easy comp because look at the World Trade Center. The World Trade Center was knocked down, and it's the same size as Herald Square, the same footage, the same footprint, and it got a $4.5 billion valuation. So that's where you are. So that's an empty lot in the middle of Manhattan, $4.5 billion. So I'm saying $2 billion or whatever, but that's still, it's just so ridiculously undervalued. And these are anchor stores in malls. And that's the other thing, by the way, malls. Now, I'm not patient enough to invest in the mall REITs, but malls will survive too. They will reinvent themselves. They are already. They're turning more towards food and specialty shops and things like that. They're getting more attracted to the consumer. They're making it more of an experiencing thing when you go there. So the malls are figuring out also how to attract shoppers back to the mall and make it a better experience for people. But again, that's a problem for them more so. Macy's, now for Macy's, it's an advantage because they exercise, where they're leasing space, they exercise buying power. Because they're like, if they leave, you're screwed. If you're a mall operator and Macy's walks out on you, you're in big trouble, especially because you're already losing Sears, right? So Macy's gets a lot of leverage when these contracts come up, which is good for them. PSA. Yeah, as I wrote at the time, I don't like 226 stocks, but they do pay an $8 dividend, and I got interested down here at 220, and we were looking at selling the September 210 puts for $9, which brings you down to 201. See, these 210 puts is where I thought the bottom would be, and we talked about selling those 210 puts for $9. Now, again, we didn't execute this trade, but we came down to test where I thought we'd be, so I kind of like it even better now. ESA. Oh, and they have, see, I feel thing. They have December out now, but let's take a look. Does 120 puts, what? Oh, sorry, 220 puts. I'm like, how's that? So they're now double, though. Those 220 puts are now double, so I definitely like them. But why would I do that when I can do December? And here, now you can sell, now you can sell the 200 puts for $10. And the 220 puts at $20. I still like that price. I still like the net 200. It's just the risk is a lot. That's my only problem with it. I think I feel more comfortable with this. I'd sell the 200 puts for $10. But that's good. That's getting the dividend without having to own the stock. It's nice. And public storage, man, that's not going anywhere. People need this public storage. You look at the numbers and you see like apartments are at record numbers. I had a news item yesterday. It was the well, I won't do it now. I'm not going to look for it now. There was a news item I read yesterday about apartment rents are going up, apartment occupancy is up. It's a record. More people own apartments now than anything else. Apartments are in, and now if apartments are in, it means people need extra space. So people like PSA do well. Qualcomm, we love Qualcomm, and it made a nice double bottom here. You can see, well, it says double bottom. In fact, it made a nice double bottom. It says double bottom right on the chart. And we liked it on 3.5, and now it's basically right back to where it was on 3.5. Great company. Target, again, another retailer that's being beaten up for dumb reasons. And not for no reason, but just come on. At a certain point, there's value. And look how I nail these bottoms, the 55 puts, right? So here we are, 217. We're 65, and I'm calling 55 and saying the 55 puts. That's exactly where we got to. So that's a great one. I love this. These puts are much more expensive now. The spread, you can go lower on the spread, although that spread's going to be fine too. And it's a good trade. Then we added. So yesterday we added Gannett. And again, they're like, newspapers, ew. It's like, yeah, I understand ew, but they're not dead yet. Okay? I mean, there were many, many times in the world where you would have said newspapers are dead. Newspapers were a thing back in Ben Franklin's time. So, I think at a certain point you might have said, oh, they're dead. Magazines were supposed to kill newspapers. Everything kills newspapers. TV was going to kill newspapers. Now the Internet's killing newspapers. But 47% of Gannett's revenue comes from the Internet now. They're not stupid. But, you have to start, you don't think of them like that. They're a news organization, and they don't really care how you consume the news. They are a provider of news. Just like Time Warner doesn't only do film anymore, right? Time Warner is a media company, multimedia company. MGM is not a movie studio anymore with like the cranky projector and the guy standing behind the thing and the string holding up the moon. That's not what MGM is anymore, but that's how they started. You evolve with the times. Gannett is evolving with the times. And they are, Gannett, the USA Today, and every local paper in America is basically Gannett. Almost everybody's got a Gannett paper in their area. So they're a huge, huge news source and a great value. And getting to the point, under $1 billion, and getting to the point where Warren Buffett might snap them up. And I'm not an M&A guy. I don't like to be like pushing M&A ideas. That's not what this is about. I think they're a great value here. I think they can totally make money at this price. They pay a fantastic dividend. But at under $1 billion to make one purchase and control all those newspapers, that's the kind of thing Buffett likes to do. So, I wouldn't mind if Buffett bought them, but if other people bought them, I'd be really, like if Bezos buys one, I'd be really pissed off. But the thing is, can you build this for that kind of money? And no, you can't. You can't build this operation for $1 billion. So it becomes something that all these different media outlets might look at them at some point and go, wow, you know what? This is something worth having. Oh, in fact, here's another. Publishing, $694 million. Corporate and other. See, corporate and other, 968,000. Silly me. So publishing, which is the big money, up 5.6%. Corporate and other, whatever that is down 30%. Okay, so but it's only 968,000. It's not millions. It's this. This is down 30%, but this is up 5.6%. People don't know how to read a report. They see and again, it's not people. This is one of the problems. It's not people. It's bots see something like this, and they go, the trading bots see something like that, and say down 30% in a segment, and that's a sell signal to them. Here it is. Digital revenues made up 30% of operating revenue. And also they had unfavorable exchange rates. And also exited operations that cost them money. So all these little things gave them dings. The revenues grew 17%. And this is how they get treated. That's mean. So this one we added to the long-term portfolio. So that's the trade we made in the long-term portfolio. We wanted to buy the shares because they pay a nice fat dividend and they haven't got much debt, so they're perfect for this kind of thing. And so we bought 2,000 shares, which is $16,600. We offset that to drop it to $13,200. Now, let's say they fall down from 8 to 0.6. Okay? So if we would spend, then we could double down and buy another 2,000 shares for $6 and that would give us that would be another $12,000. So our net would drop to $630. We're buying 2,000 more at 6, so our net would drop to $630 on 4,000 shares, and that would and we'd only be in for $25,000. Now we have $50,000 allocation blocks in this portfolio. So now, if they drop from 6 to 3, we could buy another 4,000 shares for $12,000. Our average would then be $450, and we'd still have $12,000 left. If they drop from 3 to $1.50, we could buy how much we got now? 6, 8. We'd have 8. Wait, 4, 8. We'd have 8. We could buy 8,000 more at $1.50, so the last $12,000. We're still in the same damn allocation block at $1.50. I mean, so we buy them at $1.50. Now we're averaging $4.50 and $1.50 is 6. Now we drop our average down to like $3 a share. So that's when I look at these things. I look and think about what we're going to do to scale in. What if it gets worse? What if things look terrible? Blah blah blah. And I'm like, as long as they're viable, because before they get to $3 a share, somebody's going to buy them. For $500 million, somebody's going to buy the freaking company. And I can see a clear path to us owning these guys for $3.50 a share or $3 a share, without even exhausting our allocation for one block of purchases. So do I want to be in this thing for 10 years at $3 a share? Yes, of course I do. It's $8 now. I don't think we'll ever get there. I'm not saying we will. I'm just saying, though, that that's, a lot of these stocks we look at, we buy these, and J-Bob likes to call it an FU portfolio. We buy these stocks that are going down. We try to call a bottom, but then they go down further, and then we buy some more, and then they go down further. That's fine, though. They're in a long-term down cycle. And if we pick them right, and we don't always pick them right, but if we pick them right, we end up owning a lot of the stock at a very, very low price, and then eventually they turn around. All right? The problem is most people do not have the patience for long-term strategies. And everybody talks about, oh, Warren Buffett is such a genius and blah, 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 but he holds these freaking things for 20 years. He does exactly what we're doing, except nobody pays attention until it's a big winner. And everybody acts as if he did something instantly. Like in 2009, he made a $5 billion bet. He short sold the S&P. He sold puts on the S&P for $5 billion in 2009. It just paid off this year. Not this year, last year. 7 years later, it paid off. It was a 7-year bet. I make 7-year bets too, but people freak out like in the first year if it doesn't go up. It makes no sense. So if you want to be as rich as Warren Buffett, you have to extend your time frame. And you have to build value into a company. You have to build into positions by constantly reevaluating a company. And if it gets cheaper, instead of dumping it, you have to say to yourself, okay, I now have an opportunity to take a bigger stake. That's how Buffett wins. When he buys a small stake in a company, or relatively small stake, and if it goes lower, he says, oh, great, now I can buy more for cheaper. That's how it works. And that's why people who are in businesses for long term succeed. People who buy shore houses, for example, right? They know their area, and they know that a shore house, a beach house, costs $500,000, let's say, and they know exactly how much they can rent it for. So they know they're going to have cash flow at $500,000 that makes sense to them. So whenever there's one for $500,000, a beach house that's got 2 bedrooms and 2 bathrooms and blah blah blah, whatever meets their criteria, they know that when one comes on the market, when they buy it, they're going to win. Now, they might not win this year, they might not win next year, the thing might go lower in price, but it doesn't change the fact that they know what a beach house is worth, they know what they can rent a beach house for, and they know what their long-term returns are going to be. Now, the best thing about that kind of philosophy and being that kind of buyer is these guys, when there's a recession and the market collapses, instead of panicking, they go out and buy 5 more beach houses for 20, 30% off. And that's how they get rich. It's not the day-to-day buying a beach house that makes them rich. It's being there when the thing tanks and knowing when it tanks. Not only that, though, but these guys, same people, when somebody offers them $750,000 for the beach house, they say, I know that it will take me 14 years to make $500,000, to make $250,000 on my beach house. So each of my beach houses produces this much money, and it takes me 14 years, and you're offering me 14 years money now. And I think in the next 14 years, no, don't do that. Oh, I see. All right, whatever, go away. So the guy says, I know what a beach house is worth. I know what it can produce. So when you offer me too much money, I'm going to sell my beach house to you, and I'll wait, and I'll go buy it back. That's what professional investors do. And the biggest problem with amateur investors, which most of us are, you don't do it all day long. If it's not making a living, you're basically an amateur investor. But more, let's call it casual. Nobody wants to be called an amateur investor. A casual investor wants to make money short term. They want to always see everything go up, and they don't look at it as a business, the overall trading. And also the worst part is they tend to go from one sector to another sector to another sector, and they don't have a particular specialty. And that means you don't know the value of the things that you're buying. You don't. And when I say know, I mean know like you believe it and you understand it and you know it for a fact, not that you took Cramer's opinion on something or whatever. Because when I look at Gannett, I look at a newspaper business, I look at the way they are now and where they fit in the world, and I say, okay, that's for $1 billion, I'll buy that business. And if it gets to $500 million, I'll buy 2, and if it gets to $250 million, I will buy 4. Because I know what it's worth. And I also know, though, that it may take 5 years, 6 years, 10 years for it to turn around and move forward. It might still go down for 3 more years, but that does not deter me. That's just the trend that we're in. It's a long-term, and they're in a major decline, trying to refigure out what they're doing. Just like the New York Times, which frankly just suddenly, the Times just figured out what to do, and they shot back up. Here's the New York Times. Are they NYT? And we were playing the Times when they were cheaper too, and people got fed up with them. Yeah, the NYT. So look at this magic, right? Garbage, 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 garbage. Everybody's upset. Nobody likes it. And all of a sudden, look, they bottom out. People capitulate, and then they take off. But you've got to, I don't know when this is going to happen. I wish I did. I wish I knew here that this was the day. But I don't. So what I do is I buy it here. And I plan to buy more if it goes down here and more if it goes down here. And one day I fully expect it to go back up here. But that day can be years. And so we take these trades that are 2 years, and it seems like a long time, but it's only the first leg of the trade. The 2-year leg is just the first part of the trade. We want to stick with these things long term. Freddie Mac, FMCC, this is interesting. Now, they're 260. Again, this hit my limit. I watched Freddie Mac. I've been watching it for ages, but they finally hit a price where I'm like, this is getting kind of silly. Now, the problem is they're forced to turn all their profits over to the government. So now it's $2.55. It's even cheaper than yesterday. They promised to turn all their profits over to the government. But there's all these rules kicking around where eventually they're going to be allowed to keep more of their profit. Eventually, the shareholders are going to get a victory. And when they do, their company is currently valued at like $7.5 billion. They dropped to the bottom line $7.5 billion last year. 100% of the value of the company they earn in a year. Problem is, they aren't allowed to keep it. They only get a tiny bit to their shareholders, and everything else goes to the government. Now, that pisses off the Republicans. They want them. They want to kick them off completely and tell them, okay, you're just fully private now. But doing that is a huge win for the shareholders, and it deprives the government of billions in revenue, so they're going to have to work something out. What else? Oh, yes, let's finish that up. And the last one I liked was Sealed Air. Sealed Air makes packing material, basically. Sealed Air is bubbles, bubble wrap. That's Sealed Air. So again, if you think the economy is going to do well, if you think Amazon is going to continue to do well and ship stuff, then more bubbles and more horrible those styrofoamy things. Hopefully more bubbles though. In fact, I can't believe that people don't get on a case about that because styrofoam is the worst. So either way though, there's still more bubble wrap. People use bubble wrap all the time. UPS loves bubble wrap. It seemed very obvious to me. So they popped up already from when we were talking about it yesterday. But we added it yesterday. So I like those guys. All right, so now we can go for questions. Oil report. The oil went well. I mean, oil report had a big draw for the second week in a row. We had a nice draw in oil. We're long on oil now, so I don't want to confuse anybody. We've actually flipped to be long-term oil traders, and we hit our goal today at 47.50, so that's good. But I'm very confident into the holidays we'll just keep going up, so I'm not worried about that. Oh man, this turned around. Freaking market, how annoying! Oh, Dow had a good drop, but we can bet the Dow. So how's my Russell? I'm getting tired. Tactic trader. Look at that. Now I'm down $15. That's annoying. I tell you, I ever learned not to trade when I'm doing these things, so I never pay attention. All right, still under. I'll stop out over 1400, but I'm not taking it off because I still think we're going to head down. All right. GNC, is there a double down in the near future or wait and see? No, wait and see. Okay. See, now for me, there's no point in doubling down unless you're going to net a 20% lower price. So for GNC, for example, which is, do we have our portfolios? Where do we have GNC? What portfolio? Not in the short-term portfolio. In the options portfolio. GNC. It is not. So it must only be in the long-term portfolio. GNC. Here they are. Okay. So 6,000 shares. That's a lot. I think we already did add to these guys, right? And we must have, because we didn't start with 6,000 shares. We already added to them on the way down. But GNC, we were just talking about, we were just looking at them. They're in a turnaround phase with this business also. And it's just, and again, you got to be patient. We only started back on December 16th, so we've only been in the thing for 6 months. We started at $9.80, but it wasn't really $9.80 because we sold the $5 calls, which was a conservative sell, for $3.70, and we sold the $7.50 put. So we were already forced to double down. So the net here is $9.80 minus $3.70 minus $3.40, which is 9 minus 6 is 3, minus $1.10 is, or minus 30, so 3, so 270. So our net on this batch is 270. That's all. We only pay $2.70 per share net. We're going to get called away at 750 if they're above 750. They're not above 750 yet. Or we're going to be forced to double down at 750. Now, if we're in at 270 and we're forced to double down at 750, our net would be 5. So we'll have 12,000 shares at 5, which is right back to $60,000, which is one allocation block. So the question I ask myself isn't whether I want GNC at 687. It's do I want to have 12,000 shares at 5? So still, I do. I think that's worth it. And especially if they keep paying the dividend. They pay a nice dividend. GNC pays, 7%, I want to say. Let's say GNC. And they don't have a cash flow issue. Oh, yeah, I can explain that real quick. So we'll do that. They pay no dividend. Or they take the dividend off. It's fine if they did for now. But they generally pay a dividend. Let's put it that way. Dividend. There's one. 20 cents. 20 cents. That's a lot. Let's do dividend. Can we do dividends only? Frequency show. Dividends only. Try that. Yeah, 20 cents, 20 cents, 20 cents. So only three. Well, I don't know why it goes back that far. So they've been paying 20 cents. They would have paid in March. They didn't, so they suspended the dividend. But the fact that they like to pay a dividend is very encouraging down the road. So do I want to have 6,000 shares and get a 20-cent dividend on 6,000 shares? Yeah. Quarterly, that's really good money. So it's a nice dividend if they start paying it again, which I assume they will. And the problem they're having now, and they're only $500 million, and they've got, not that, profile. How many stores do they have? 9,000 locations. Okay, 9,000 locations, and they're being valued at $500 million. So basically, $500,000 per location. Right? 9,000 times 1,000. 9 million. No. Wait a minute. 9,000 times 1,000 will be 9 million. And then 400 million is going to be I want to say $50,000. Yeah, $50,000. They're being valued at $50,000 per store. What? Hang on a second. That just sounds wrong. Okay. 469 million. 469 million divided by 9,000. Oh man. It just seems so wrong, doesn't it? So they're valued at $52,000 per store. I'm done. I'm not even going to explain that any further. That's a little low. So anyway, so the bottom line is yes, I like them at that price. They're spending money. They spent a lot of money to turn it around. They also, by the way, very, very stupidly bought back their own stock. Not everybody buys back their own stock as a winner, and GNC was a big loser doing this. They bought back their own stock when it was much more expensive. So they borrowed money, bought back their own stock, and then it tanked. They thought it was worth more. The market does not. So now they have the debt, and they bought back their stock and wasted all this money. So now they have to pay the loan back. They got to recapitalize the loan. And somebody was doing math and saying, oh my God, they recapitalize their loan at such and such a price and this and that. That's not how it works, okay? It's not, you don't end up, you're not going to lose 5 points recapitalizing your loan. They will turn around and they will fix their stuff, and once they have their financials in order, they'll come back up. So that, and then hopefully they'll start paying a dividend again. So would I double down? No, I would not double down because we have a basically full position. So, and we're in it like $6 a share. If we get assigned at $7.50 another round, we're in at $5 a share. Sorry. If we get assigned, if it goes down to 5, we'll be assigned the 750s and we'll be in at 5. Then we'll sell calls. We probably won't sell puts, but maybe if we sell, but then what if we could sell puts and calls that drop the price from 5 to like 3 or 250? Then there'd be no reason not to double down. See, think about this. If I've got the stock and it's at 5, all right? So let's say it drops from where it is now to 5. We're going to get assigned. Our net is 250 on the first round. So if we get called away above 750, we make great money. Our net is 250 on the first round. If the stock is at 5, though, what's going to happen is we'll be assigned another 6,000 shares at 750. That will bring our average up because we're doubling down at 750. not voluntarily, but we have to because we sold the puts. Our 250 net becomes 250 plus 750 divided by 2 is 5 on 12,000 shares, right? So at 5, obviously, I'm not going to want to double down because that's where I'm going to get assigned. But if we have 12,000 shares at 5 and then it drops further, I wouldn't double down, but what I would do is I would sell the 250 calls and the 250 puts. And if I can get 250 for the 250 puts and calls, that would drop my net on the 5 to 250. And then if I'm assigned, I would be assigned again at 250. So we would be able to double down without putting any more cash into the mix. That's the beauty of running this system. But the problem is it's very hard for people to understand it because they don't think in terms of these long time frames. It only becomes obvious. That's why I keep a long-term portfolio running for 3 years so far, because it wasn't getting through to people, and I still have trouble getting this through to people, so I'll talk about it every once in a while, is that you can't look at a position as a one-time thing. All right, so when we initiated GNC, we sold the $5 calls for $370, and those $5 calls were in the money. It's not like GNC. We did it in like April. When we sold the $5 calls, they were at $650. We sold deep in the money calls because we expected them to go lower. It's doing what we thought it would do. We sold the $750 puts because that's our target for 2019, 2 years from now. We think they'll get back over $750. We sold those for $340 because they were in the money. But the bottom line is we collected $7.10 against a $9.80 purchase of stock. That left us with only $2.40 out of pocket. So our net here is $2.40. If we get called away at 5, now, two things have to happen. If we get called away at 5 and it's over $7.50, that means the puts go worthless, and these are 5, and that means we make $6,000 times $2.50. That would be our profit. But we didn't lay out $50,000. We laid out $58,000 minus $42,000 is $16,000. So we laid out $16,000. We'll make a $12,000 profit, or $15,000 profit. Actually, we'll make a $15,000 profit. We'll make 100% profit at $7.50 on this spread. So we don't really give a crap if it goes lower right now. And frankly, if it does go much lower, like I said, if it goes down to $2.50, then we'll get it signed at $7.50. Our average will become $2.50 plus $7.50 is 10 divided by 2 is 5. And then at $2.50, we do the cycle again. And we sell more puts and calls, and we drop our basis again. But that's 2 years from now. It's not even, that's what will happen in 2019 if they continue to go lower. Meantime, the position, at the moment, the position on paper is down $17,000. Why? Because the puts and calls still have a tremendous amount of premium in them. So this position won't look good for a long time. Now, also, though, if you buy it as a new position, it's a way better price now than it was when we got it because the puts and calls have held value. But now you can buy the stock for $687 instead of $980. I didn't know that was going to happen. I would have been very happy to save $18,000. But I didn't know that was going to happen, but it doesn't change the play, and it doesn't change the net of the spread. So it's a much better play now than it was before. But I wouldn't double down on it because my plan is I want the cash on the sideline in case it totally tanks. So if I jump to double down now, although it's tempting, it just we can make the position a bit larger than I want it to be to maneuver it later. That's the deal with that. On GE, do you mean sell the puts? I'm sure I do mean sell the puts. I'm not sure what you mean, but I often say calls when I mean puts. I keep writing call, put, blah blah blah, and I mix them up. So on GE. Ah, there's GE. Whoa, stop. You're selling the 32 calls and then buy the calls. And and then just sell half of the. Oh yeah, these should be puts. Obviously because of the context. Sell the $32 puts for $440, and that gives you a $27.60 entry. Selling the calls wouldn't do that. Not only that, but you could. But also the 2019 calls are not $440. That's the thing. So yeah, I did mean the puts on that one. That is my version of dyslexia. I seem to mix up puts and calls, which is not good. There's another interesting way to play this one, and that's effectively buy it, selling the calls for $440 for a net $26.70. Oh, I see. You're explaining what I said. Good. Yeah, so we're on the same page now, I hope. Big red candle on YM. Any news? I don't know. It could be anything. That, and obviously it reversed already, so just more nonsense. Frontier 135 starting to look scary. Is anything? Nope, same thing in Frontier. They borrowed $10 billion to double the size of their company. They're a very, very successful little company. It was a very big pill to swallow, and all the jackals are attacking them now because they've slowed themselves down and they've stopped expanding, and they're having to do all the crap that people have to do when they acquire companies, and they do not have a lot of free maneuverability, free cash flow or maneuverability right now. It's very, very tight, but they knew it would be very tight. But they would not have won the bid to buy Verizon's assets if they hadn't hit this number. They knew exactly what they were doing when they did it. I think the only thing they didn't understand is how vicious the reaction would be by the market. That's what they miscalculated. They miscalculated the transaction. Everything is going exactly the way they thought it would. They didn't understand how viciously they would be punished. And that's what's going on. And I see no reason not to stick with Frontier. I think they're fantastic. And again, it's the same thing as GNC, though. Until they get to 80 cents, I'm not interested in doubling down. 80 cents, though, we are doubling down. Clinton says, who goes to go buy vitamins? I haven't been in years, and I was one of those things. I buy those things with Amazon. What am I missing long term? You're not missing much. It's just, again, it's for $50,000 a store. Enough people go to buy vitamins that it's worth it. That's all. I'm not saying it's a big thing. I'm not saying it's a major trend. I'm just saying that there is a. Okay, and also most people, you're into vitamins. People who aren't into vitamins go to the store. They have no idea what they're doing. People who are starting off on that track, and there's always people who are starting off on that track, seek guidance. Okay, my doctor, I seek guidance. My doctor told me I need to take potassium. So I take potassium. And I went to GNC, and I said to the guy, what kind of potassium pills do you have, and blah, blah, blah. Because I was like, why am I buying potassium at CVS when I can buy potassium at GNC? And so again, it's relatively, I'm sure I could buy it online cheaper. I still wanted somebody's guidance and pills. So he gave me some supplements for potassium also. But, people like a little bit of guidance and like talking to people and don't always buy everything off the web. If you know what you want that's different, and you buy it by this or that. But if you're just starting out with your exercise and you go into the store, and they're learning that, they're becoming kind of like a little bit of a Weight Watcher kind of model where you go into GNC and they want to be like guides, where they guide you through a process and say, what is your goal? And let's work with you, and let's create a profile, and let's take you through a process to get you in shape or get you where you want to be with whatever. That's what they're aiming for, and it's a good idea, and I think it's going to be popular. But again, it takes a long, long time to revamp their whole system. And I think the base business is supported. They're not losing money. This is, again, people act like they're bankrupt. It's insane. Is it still GNC? Okay, well, this is when they're redoing their stores here. Generally, though, 255 sales are steady. They're capable of making a couple of $100 million on their billion-dollar valuation. What they did, though, is they spent a lot of money retooling their stores. It gave them a bad year. They already, this quarter, first quarter, $23 million. After spending, in other words, here, they spent that much money remodeling their stores. 9,000 stores cost a lot of money to remodel. In fact, 50,000 a store. We're back to that number. They spent $50,000 per store remodeling. And now they're pushing to get sales back. And look what happened. That was the other thing. They actually closed in December. They closed their stores basically for the month of December. So they blew off a whole month of sales, Christmas sales. And of course, people don't really buy vitamins for Christmas. But they blew off like a whole month, closed their stores, remodeled their stores. They opened them back up. Now they're doing the retraining thing. They're in a whole cycle. And they already went cash flow positive. I don't know. What more can you want from somebody? They're being priced as if they're bankrupt. They're not. When somebody's being priced as if they're bankrupt and they're not bankrupt, that's a buy to me. There's a big, big difference between bankrupt and not bankrupt. And so if you can get a bankruptcy price but the store's not bankrupt, it's a good deal. Anyway, all right. Oh, wow, 3 o'clock on the dot. All right. Sorry about the late start today. That was my bad, and I'll hopefully not do that again. I was just totally like busy doing something and didn't even realize it was a webinar time. Anywho, we will call it a day here. I'm still short on that guy. Now I'm positive again. How stupid was that? I should have sold another one when we were up here. When I was losing money, instead of complaining, I should have just sold another one. Because I wanted to. I forgot. All right. Anyway, so I'm still short one here. I'd like to be short two. I don't see any reason the market should be really any more excited than they were. And we'll see what happens. Still like oil long. Now, at this point, I would not initiate an oil long, but if they go back over 47.50, I would play that line with tight stops, and hopefully we take off from there. Gasoline, too late. That you missed the bus on. That was a great move on gasoline. Gold and silver, both good plays. Silver down here, gold down here. Coffee, whenever it's at 135, we like it. It's at 136 something now. And as for the indexes, though, I don't see the S&P holding 24. I don't see the Dow holding 21,000. I do not see the Russell holding 1,400. I still think we need a good pullback, and it's so weird that we just can't get it. So we'll see what happens. But that's going to be it for today, and thank you all for coming. And we'll do it again next week. Who's saying something, right? All right, last couple of questions. Where do you see Apple in January? So this January, I see Apple, try to factor in like the iPhones. The new iPhones will be out in October. And so when you say January, basically I think the numbers are going to be stunning, and they should probably hit 160 toward the end of the year. We're going to have to be moving our positions also and being a little more aggressive. But I think they could easily hit 160. Next year, 180 plus, into the end of next year, 180 plus. You can't stop them. They're just going to grow and grow. I think, though, the market pulls back. The reason we haven't really moved on the Apple yet to expand our position is because they're going to go down when the market falls. If the market ever falls, they'll go down with the market for no good reason, and then it'll be a great opportunity to adjust our position. I don't want to adjust it now. It's still a bit high. For this moment right now, it's still a bit high, and they're totally subject to falling with the market. Still in RB. No, we were perfectly happy at 155. We took that off. Do you see QQQ making new highs? Again, same as the NASDAQ. I just think it's got to be done. I think we're too high now. I think it's just overdone. So I want to see a pullback first before we talk about new highs. And also, you see these stocks that are losing, they have earnings, they drop 20% on earnings. When you see that happening, that means stocks are overpriced, okay? Stocks shouldn't drop 20. People shouldn't be, and I'm not talking about big misses either. I'm talking about like not so big misses, 20% drop on a stock in one day. That's crazy. That means people are completely and utterly mispricing stocks. Stock doesn't move 20% because people know what they're doing. It moves 20% because people are idiots and are buying something that can't possibly hit the numbers they're expecting. That's true of the broader market, but you don't see it so obviously. But when you see that many, you see a lot of stocks dropping 10, 20% on a regular basis on bad earnings plays, and not too many jumping 10 or 20%, you start to realize like something's wrong with the valuation. And that's where we are right now. There is something wrong with valuations. They're not there. If they repeat this quarter's performance next quarter, I will tell you that I will flip longer. But I think this quarter, since we had terrible comps last quarter, it's an aberration. Would you look for a pull? Yes, and yes, obviously, we always look for a pullback on Apple to go long. Every time we get out of Apple, we regret it like 5 minutes later when we look to get long again. TEVA earnings. What, did they have earnings today? Or they're having earnings? Very last one. Even if you're asking another question, I'm not talking yet. Gotta go. Earnings, what's in the front? Oh, no, they're earning. Okay, so TEVA earnings. May 11th. Okay, so that's not even today. That's it. TEVA is going to do whatever they do. Oh, wait. Should we take it? A little bit higher. 10-7. 10-7 on the way. Ah, look at that. 14. 11-9. I'm still going to wait. All right. Still 13-8, so I'm not going to go 15-6. Still going up. 9-12. All right, now I'll take it. There we go. All right. Now I feel better. So now I have the two that I wanted. We're right back in the same place, 139875, and we will see what happens. And I will take a quick loss. If we're plowing over 14 and everybody's going up into the close, I don't know if I want to hold it overnight. No, I changed my mind. Nope, I will. Because if it goes up right now, will an hour go into the close? If we're up a little bit, I'm not going to really take it off of that, because that's just a stupid, closing pump job that they do all the time. Unless there's something going on I'm not aware of, but I don't think there's any good reason it should be higher. All right. That's it now. Now I mean it. All right, guys. Thanks for coming. We'll do it again next week. Take care.